Hello everyone, welcome back to our Financial Foundation segment. This is Zita again. Today we come to the second episode of our How Money Gets Taxed series. But before we dive in, let's recap what we talked about in our last episode. In the last episode, we talked about the history of taxation as human civilization evolves. And we also mentioned that nowadays, income tax is a main source of taxation for the United States federal government. We laid out the 4 buckets of the income tax, which are tax now, tax qualified, tax deferred, and lastly, tax advantaged. Albert Einstein once said, "The hardest thing in the world to understand is the income tax." However, we are going to make it easier for you by dissecting the 4 different buckets of how our income gets taxed. Let's now take a look at the first bucket, tax now. Sometimes we also refer this bucket as the taxable bucket. These are the money that you will need to pay tax on or include in your current year taxable income once you earn them. They include, but not limited to, bank savings, CDs, or money market, non-qualified brokerage accounts such as stocks, mutual funds, ETFs, and bonds, rental income from your investment properties, cryptocurrency tradings, or basically anything that gives you Internal Revenue Service 1099 form each year. Even if you didn't pull the money out, falls into this bucket. Money you made in the tax now bucket could be taxed at either the capital gain tax rate or ordinary income tax rate, depending on how long you have held the principal. Now, let's look at the following 2 samples to have a better understanding of these rates. First example, let's say you purchased $10,000 Tesla shares in your non-qualified brokerage account on January 1st, 2022, and your investment grows to $20,000 on April 1st, 2022. Then you decided to sell the shares on that day, not counting any potential transaction fees to be deducted. The $10,000 gain you realized will be included in the taxable ordinary income in the current year, since you held the shares for less than a year. Second example, you purchased $10,000 cryptocurrency back on January 1st, 2021. And you sold it on April 1st, 2022 at a price of $20,000. Again, not counting all relevant fees. The $10,000 gain will be included in the long-term capital gains in 2022 and get taxed accordingly. The long-term capital gain tax rate is typically more favorable than the ordinary income tax rate. That's it for this episode, and I'm looking forward to seeing you again in our next video.
We are Chains Explained, your one-stop shop for blockchain and financial education.